How to prepare for the next crypto crash. The cryptocurrency market is notoriously volatile. That can mean drops of more than 50% in a matter of months, as well as rapid price gains. After a price spike in November 2021, prices have trended downwards in recent months. It isn't yet clear whether this is part of a bigger crypto market crash. It certainly is a healthy reminder that crypto prices can go down, and investors need to be ready. But first, let's see what causes the crypto market to crash. What is crypto crashing? Crypto's price moves can be affected by many factors, which include interest rates, inflation, and other macroeconomic factors that can affect how confident people feel investing their money in risky alternative assets. Another factor that can drive investor pessimism and may lead to crypto crashing is government actions by regulators around the world. As interest in crypto has grown, public officials are reckoning with what the technology might mean for monetary policy, security, and environment. China has been particularly aggressive. On September 24, 2021, for example, prices dropped after the Chinese government declared cryptocurrency transactions illegal and said overseas exchanges are not allowed to do business with people in China. The drawdowns in early 2022 come as the crypto market has been bracing for action from the United States government on multiple fronts. As monetary policy makers firm up their plans to slow inflation, the Biden administration is also reportedly set to unveil a broad strategy for how to handle digital assets. Developments like these are a reminder that cryptocurrency remains a relatively new technology, whose full effects of the worldwide economy are not yet clear. Crypto prices are volatile, and unanticipated events can send prices downwards. Now let's get into what you can do to avoid being a victim of the next cryptocurrency crash. But first, make sure to subscribe to Altcoin Universe so that you can stay up to date with all the new things happening in the crypto world. As an investor, there are several ways to prepare for a market crash. Here are 4 of them. Number 1. Only invest money you can afford to lose. The golden rule of investing in a risky asset class like cryptocurrency is to only invest money you can afford to lose. When you see stories about cryptos that gained over 5,000% in a year, it's easy to get carried away in the hope you can see similar gains. But only a handful of cryptocurrencies produced those returns last year. With over 17,500 cryptos on the market, it takes a lot of luck to pick the one that will skyrocket. Indeed, given the changing economic environment, there's no guarantee any coins will see similar returns in 2022. If you stretch your budget or borrow money to buy a cryptocurrency and the market falls, you could find yourself unable to cover everyday costs like groceries or your accommodation costs. On the other hand, if you only buy crypto with money that you can afford to lose, a crash will be disappointing but not devastating. Importantly, you won't be forced to sell at a loss. Instead, you can hold on and wait for prices to recover. Number 2. Invest in cryptocurrencies with long-term potential. There are many different attitudes towards cryptocurrency investing. Many people see it as a good short-term speculative buy. Others want to get in early on what could be a transformative technology. Taking a long-term perspective is a great way to guard against panic selling when prices drop. If you plan to hold on for the next 5 to 10 years, you're more likely to research carefully before you buy, and it's easier to see a market crash as part and parcel of crypto's volatility. Picking cryptocurrencies with long-term potential is not easy. Many promising projects did not survive the great crypto crash of 2018. Some experts say 90% of cryptos would not survive a prolonged crash. Research can help identify cryptos with the best chance of long-term survival. Here are some factors to look out for. Is it an established cryptocurrency? It's true smaller cryptocurrencies have a better chance of producing significant gains, but they also carry more risk. In contrast, better-known cryptos like Bitcoin or BTC and Ethereum or ETH with higher trading volumes have a better chance of surviving a serious crash. Does it have a purpose? Think about what problem the crypto promises to solve and how many people might benefit from that solution. Look at what its competitors are doing and how it compares. If the market collapses, coins with no utility are more likely to fall. Does it have an experienced and reliable leadership? Management is key to guiding a project through difficult times. Conversely, if a project has leaders that are anonymous, it's a big red flag. Does it have an active development community? If a project doesn't have many developers working on it, it may already be failing. Number 3. Make sure you have an emergency fund. Emergency savings are like a financial airbag. They pop up and cushion you against unexpected disasters. Try to keep 3 to 6 months worth of living expenses in an easily accessible bank account. It may seem like a lot, but this will tide you through if you lose your job or face another financial crisis. A solid emergency fund can take some time off the stress out of a crypto market crash, as it gives you the reassurance to know you can still meet your financial goals. If you don't yet have a well-stocked emergency fund, start putting a small amount aside each month until you do. Number 4. Make sure cryptocurrencies only represent a small percentage of your overall investments. High-risk investments like cryptocurrency should only make a small portion of your total portfolio. There are various ways you can calculate how much you want to allocate depending on your risk tolerance, your crypto knowledge, and the degree to which you believe crypto could outperform stocks. But the crucial thing is to diversify. If you avoid overexposing yourself to any individual asset class, you'll be able to handle it if one sector, like crypto, collapses. Crypto experts suggest refraining from all-in moves when deciding to invest. If you buy a whole bunch at once and the price drops, psychologically that's very difficult for people. Buy a small amount every month and then just keep doing it as the price goes up or the price goes down, as opposed to buying it all in this one single crystallized cost, which you're going to have to deal with psychologically for the foreseeable future. Personal finance experts often say that any single asset, be it a specific coin or company stock or something else, should only be the sprinkling atop the parfait of an otherwise vanilla portfolio of stocks, bonds, and mutual funds. That means to help you achieve your long-term financial goals. If crypto is the only asset you're investing in, you're probably taking on way too much risk. We don't know whether crypto will pick up again in the coming months, or whether this is the start of a longer downturn. Some are already calling it a crypto winter, but it's much too early to say. One big factor is increased regulation, which could have a significant impact on cryptocurrency prices in the short term. As a crypto investor, the best way to be prepared is to think long-term, diversify, and make sure you also have money in other assets. These may include cash holdings, real estate, stocks, and other investments. Cryptocurrency is an exciting asset, but it should never be the only one. And that was all from us today, folks. We hope you found this video informative. Make sure to like it and subscribe to the channel for more interesting cryptocurrency content. And remember, protect your wallet at all times.